For over a decade, the global economy operated under the comforting illusion that prosperity could be created with the push of a button and the printing of more currency. Central banks slashed interest rates to near zero, and liquidity became abundant. Investors, corporations, and governments all adjusted their behavior to this new environment, one where money was cheap and capital was always available. It felt like a golden age of opportunity. Asset prices soared, markets broke record after record, and debt levels climbed without fear of consequence. But what we were truly witnessing was not sustainable growth, it was an era of artificially inflated wealth, a world living off borrowed time. The illusion of endless prosperity was born from the belief that monetary policy could override the natural forces of economic cycles, that we could outsmart scarcity by printing abundance. During this period, capital allocation became distorted. Companies that would have never survived in a normal interest rate environment thrived on easy credit. Investors stopped asking hard questions because liquidity made everything look profitable. Governments expanded spending with little restraint, believing low borrowing costs would last indefinitely. The system rewarded risk-taking without consequence, speculation without discipline, and consumption without productivity. It was a time when paper gains replaced real progress, when financial engineering replaced innovation, and when people came to believe that markets only went one way up. Every asset, from real estate to equities to cryptocurrencies, was buoyed by the same tide of easy money. The problem was that this tide was never infinite, it was borrowed from the future. As money became easier, the connection between price and value weakened. Financial markets stopped reflecting fundamentals and instead began mirroring sentiment. The idea that central banks would always step in to rescue markets created a moral hazard, a belief that downturns were no longer part of the natural order but anomalies to be prevented. Investors began to behave as if risk had been eliminated, ignoring that every boom carries within it the seeds of its own correction. The longer this illusion persisted, the more fragile the system became. Companies expanded recklessly, individuals took on excessive debt, and nations assumed growth could be maintained simply through policy intervention. It was not real prosperity, it was leverage disguised as wealth. The illusion was powerful because it felt good. Low interest rates meant mortgages were affordable, businesses could borrow cheaply, and stock portfolios kept climbing. It created a psychological reinforcement loop, convincing both policymakers and the public that the system was stable and under control. But the truth was that the foundations of this prosperity were built on unsustainable assumptions. Productivity growth stagnated, inequality widened, and real economic progress slowed. Even as financial indicators painted a picture of strength, the prosperity many celebrated was not earned through innovation or output, but through the expansion of balance sheets and the suppression of cost. The end of this illusion began subtly. Inflation, once dismissed as temporary, started to rise. Central banks, forced to confront the consequences of their own policies, began tightening conditions. The very liquidity that had supported asset markets started to retreat. Suddenly, the same forces that had fueled the boom became sources of vulnerability. Companies that had thrived on cheap debt faced refinancing risks. Investors who chased returns without caution faced sharp losses, and households accustomed to abundant credit found themselves squeezed. What was once perceived as stability revealed itself to be fragility. The illusion of endless prosperity evaporated as the true cost of years of easy money surfaced. The end of easy money is not merely a shift in policy, it is a reckoning with reality. The assumption that prosperity could be manufactured indefinitely through credit expansion has collapsed. The natural laws of finance, risk, reward, discipline, and scarcity are reasserting themselves. The world is waking up to the truth that real wealth is not created by liquidity injections but by productivity, innovation, and the creation of value that endures beyond market cycles. The illusion has faded, leaving behind a hard but necessary lesson about the limits of monetary power and the inevitability of economic balance. Rising interest rates are doing what they always do. They are revealing what years of cheap credit tried to hide. When money is nearly free, everyone looks financially strong. Businesses borrow aggressively, investors take bigger risks, and governments expand spending without restraint. Debt seems harmless when its cost is low, and the illusion of endless liquidity creates confidence that the good times will last forever. But when rates rise, the mask falls. Suddenly, the same decisions that looked wise in a zero-rate world begin to look reckless. Leverage, once seen as a tool for growth, turns into a heavy burden. This shift exposes imbalances that were quietly building beneath the surface of global markets. It's not the rise in rates itself that causes the pain. It's the unwinding of a decade of distorted incentives and artificial stability. The return of higher interest rates is the most powerful truth serum in finance. It separates real strength from illusion. Companies that relied on constant refinancing now face the reality of higher costs and tighter conditions. Investors who borrowed to chase returns are learning the hard way that leverage magnifies losses just as much as it boosts gains. Governments burdened with historic levels of debt must suddenly prioritize because every additional dollar borrowed now comes with a tangible cost. The comforting era of free money is gone, and with it the complacency it fostered. Markets that once ignored fundamentals now have no choice but to rediscover them. Every decision, every investment, every budget must now confront the discipline of real interest rates. The effects ripple across every layer of the economy. In households, rising mortgage rates make people rethink purchases, shifting demand patterns and cooling overheated housing markets. In corporations, capital spending slows as projects that look profitable at 2% borrowing costs become unfeasible at 7%. Financial institutions accustomed to abundant liquidity tighten their lending standards, forcing smaller businesses to confront funding gaps. Even nations face new realities. Currencies fluctuate, capital flows reverse, and fiscal policies come under pressure as investors demand compensation for risk. What's unfolding is not random. It's the natural rebalancing of a system that had been stretched beyond its limits by years of artificially cheap capital. The exposure of imbalances is both painful and necessary. It reveals who was dependent on debt rather than productivity, who mistook speculation for strategy, and who built wealth on the shifting sands of liquidity instead of the bedrock of value creation. The businesses that overexpanded during the easy money years now face contraction. Venture capital, once overflowing with excess cash, becomes cautious. Startups that thrived on funding rounds rather than profits are suddenly forced to face the market's real test. Can they survive without constant infusions of cheap capital? Many won't, and that's part of the cleansing process that every financial cycle requires. For investors, this environment demands a new mindset. The days of passive gains driven by central bank support are gone. Asset prices now must earn their valuations through actual performance, not promises. The repricing of risk is reshaping portfolios across the world, forcing capital to move toward productivity and stability rather than momentum and hype. Those who understand cycles see this not as collapse, but as restoration, a return to the natural order where discipline, diligence, and understanding of value determine success. When interest rates rise, they reintroduce friction into a system that had become too smooth, too easy, too complacent. That friction is what tests resilience and rewards prudence. The tightening of monetary conditions is also reshaping psychology. Confidence, which once rested on the assumption of endless support from central banks, now must be rebuilt on fundamentals. Investors are learning once again to price risk, to evaluate real earnings, to differentiate between speculation and productivity. The market is beginning to rediscover its purpose, to allocate capital not to those who promise the most, but to those who can deliver the most. This shift is uncomfortable because it challenges the habits of an entire generation that came of age in a world without real cost of money, but in that discomfort lies renewal. As rates climb, the global economy is being reminded that money has value and time has a price. The speculative bubbles inflated by cheap liquidity are deflating, revealing what's real and what was fantasy. It's a process that feels punishing in the short term, but restorative in the long term. Rising interest rates are not the enemy, they are the mechanism through which excess is purged, accountability returns, and equilibrium is restored to a system that forgot what discipline looked like. True value and productivity are returning to the center of the financial world after years of being overshadowed by speculation and liquidity-driven growth. When money was easy, investors stopped asking what something was worth and started asking only whether its price would rise. Companies were rewarded not for creating real goods or services, but for storytelling and expansion fueled by cheap capital. The market became addicted to momentum, chasing whatever was rising without questioning why. But as the tide of easy money recedes, a deeper truth is resurfacing. Real wealth is built on productivity, not perception. The capacity to create, to innovate, to solve real problems, and to sustain profit through genuine demand is once again becoming the measure of value. The shift is fundamental because productivity is the only true driver of long-term prosperity. It reflects how efficiently we transform resources into output, how effectively we use human creativity, and how much real progress we generate for society. For too long, financial markets operated as if value could be manufactured through leverage and financial engineering alone. Prices rose not because output increased, but because liquidity inflated valuations. This separation of value from productivity created an illusion that growth could continue indefinitely, even when underlying fundamentals weakened. The correction now taking place is not punishment. It is a re-linking of price with purpose, a realignment of markets with reality. As capital becomes more expensive, investors are rediscovering the importance of cash flow, profitability, and resilience. Businesses can no longer rely on raising new funds every year. They must prove they can sustain themselves. This is shifting power back toward firms that focus on efficiency and innovation rather than hype. The speculative ventures that thrived on narrative but lacked substance are now struggling, while companies grounded in strong fundamentals are beginning to stand out. The return of this dynamic is healthy because it restores integrity to the financial system. It ensures that capital flows to those who can use it productively rather than those who simply promise the highest return. The same principle applies to individuals and nations. Easy money made people believe that wealth could be achieved through access to credit and market timing. But now, the ability to create something of lasting value is being recognized again as the true source of prosperity. A society cannot grow by endlessly borrowing or speculating. It must produce. Productivity is the foundation that supports every sustainable economic system. Without it, the wealth created by rising asset prices eventually evaporates. The reemergence of productivity as the dominant measure of success is forcing a cultural shift from instant gratification toward long-term value creation. This transition is not just economic, it is psychological. People are beginning to understand that value is not defined by what others are willing to pay temporarily, but by what something contributes over time. Investors are learning that stability and endurance often matter more than speed and excitement. In this environment, understanding becomes a competitive advantage. Those who can identify true productivity, who can separate signal from noise, will thrive. Those who mistake speculation for success will struggle. It is a test of patience, discipline, and comprehension, a return to the timeless principle that sustainable wealth requires substance behind the numbers. On a global scale, economies built on consumption and credit are being challenged to pivot toward production and innovation. Nations that depend on financial leverage are facing the limits of that model, while those investing in technology, education, and infrastructure are better positioned to adapt. The flow of capital is beginning to favor the real over the imagined, the tangible over the inflated. As productivity reclaims its place as the foundation of value, markets will start rewarding the creation of solutions instead of the creation of bubbles. This is how economic evolution works. When the speculative excesses of one era collapse, the system recalibrates toward productivity and purpose. What we are witnessing today is not the end of opportunity, but the purification of it. Real value is returning to its rightful place, and with it comes a more sustainable, more grounded form of growth. The future will belong to those who understand that the path to lasting prosperity is built not on financial illusions, but on the quiet, consistent power of productivity. The system is healing itself through discipline and the repricing of risk. What looks like instability on the surface is actually a process of correction, a return to balance after years of excess. When money was cheap and risk was mispriced, the natural signals that guide healthy economic behavior were muted. People took on more debt than they should have, investors ignored fundamentals, and institutions built fragile structures on the assumption that liquidity would never dry up. But markets, like nature, have a way of restoring equilibrium. When central banks tighten and capital costs rise, weak structures begin to crumble, exposing inefficiencies that were hidden by abundance. It feels uncomfortable because it challenges years of habits, but that discomfort is precisely what strengthens the system. Discipline is returning, not by choice, but by necessity. In financial cycles, periods of excess are always followed by periods of correction. The easy money era distorted perceptions of risk and reward. Investors were rewarded for taking more risk, not for managing it. Debt-fueled growth was mistaken for prosperity. When interest rates began to rise, the invisible became visible. Companies that relied on rolling debt found themselves trapped. Governments that spent recklessly discovered the limits of fiscal illusion. Consumers who built lifestyles on credit began to feel the squeeze. This process, while painful, is essential. It reminds everyone that risk cannot be eliminated. It can only be transferred or delayed. The repricing of risk is the market's way of bringing honesty back to valuation. It tells the truth that had been ignored during the boom. Not all investments deserve the same premium, not all borrowers deserve the same rate, and not all promises can be kept. Discipline, both financial and psychological, is the antidote to the excesses of easy money. When borrowing is expensive, decisions become more thoughtful. Businesses scrutinize expenses, investors research deeper, and households prioritize needs over wants. This behavior collectively strengthens the economic system. It filters out waste, inefficiency, and unsustainable practices. The tightening of conditions does not destroy value, it reveals it. Those who have built on solid foundations endure, while those who relied on leverage and speculation are forced to adapt or disappear. Every past financial cycle has shown the same pattern. Periods of discipline are what rebuild trust and stability after years of indulgence. The repricing of risk also restores fairness to markets. When money was free, capital often flowed to whoever shouted the loudest or promised the most exaggerated return. This encouraged moral hazard and rewarded short-term thinking. Now, as interest rates normalize, markets are once again differentiating between the prudent and the reckless. Those who manage risk effectively are being rewarded, while those who ignored it are facing consequences. It's a cleansing mechanism, one that ensures capital flows toward productive uses instead of speculative ones. The pain of adjustment is real, but it is also the price of integrity. Without it, the system would collapse under the weight of its own excess. From a broader perspective, the healing process extends beyond markets to the mindset of participants. For years, people were conditioned to believe that downturns were unnatural, that central banks would always intervene to prevent pain. That belief weakened the collective capacity to endure volatility. Now, as intervention becomes limited, resilience is returning. Investors are learning to live with uncertainty, to respect risk, and to plan for different outcomes. This shift in psychology is as important as any policy change because it reintroduces caution and foresight into decision-making. The emotional cycles of greed and fear which drive markets are recalibrating toward equilibrium. As discipline returns, it is reshaping priorities. Companies are focusing on profitability instead of growth at any cost. Lenders are re-evaluating creditworthiness with renewed rigor. Households are cutting back on excess consumption and rethinking saving. Even governments are being forced to confront fiscal limits as debt servicing costs rise. The system is slowly but surely purging inefficiency and rewarding prudence. This is what healing looks like in an economy. It is not a smooth process, but a necessary one. The chaos and volatility of transition are simply the symptoms of a deeper restoration. The repricing of risk brings clarity. It exposes which parts of the economy were built on genuine productivity and which were inflated by speculation. It reminds all participants that stability is not created by avoiding downturns, but by learning from them. The cycle of excess and correction is as old as finance itself, and though it often feels punishing, it is what preserves the long-term health of the system. Through discipline and honest pricing of risk, markets are re-establishing trust, rebuilding resilience, and creating the conditions for a more sustainable era of growth. Sustainable prosperity requires humility, balance, and real economic output. For too long, growth was measured in illusions, stock prices, credit expansion, and the size of balance sheets. People mistook rising numbers for real progress, forgetting that prosperity built on leverage and speculation is temporary. True prosperity endures only when it is grounded in productivity, stability, and the ability to adapt. The age of easy money allowed many to forget this truth. When capital is abundant and risk feels distant, humility disappears. People believe they can predict markets, control outcomes, and defy cycles, but economic reality always reasserts itself. The current transition is teaching the world once again that enduring wealth is not a function of financial engineering, but of value creation and disciplined balance. Humility is the first step toward sustainable prosperity because it recognizes the limits of control. Economies are complex systems driven by cycles of credit, emotion, and behavior. When policymakers, investors, or corporations act as if they can override those cycles, they invite instability. Humility forces decision makers to plan for what they cannot predict, to save in good times, to prepare for downturns, and to respect the role of uncertainty. The last decade was defined by overconfidence. Central banks believed they could fine-tune the economy indefinitely. Investors believed they could leverage infinitely without consequence. Consumers believed they could live beyond their means forever. Each of these beliefs is now being tested. As reality returns, humility becomes not just a virtue but a survival skill. It allows people and institutions to adapt rather than collapse. Balance is the second pillar because no system can sustain growth without proportion. For years, economies grew faster than their foundations. Debt grew faster than income, consumption outpaced production, and asset prices rose faster than value. This imbalance could persist only because money was cheap and liquidity abundant. But balance always reemerges as a natural force. Higher rates, lower valuations, and tighter credit are not punishments, they are corrections. They remind us that prosperity must be earned, not borrowed. Balance also applies to how nations operate. Countries that depend solely on consumption or debt are learning the importance of diversification and self-sufficiency. Those that ignored productivity in favor of financial manipulation are facing structural weaknesses. To rebuild balance is to rediscover discipline, to ensure that the pursuit of growth never comes at the cost of stability. The third element, real economic output, is what gives prosperity substance. Wealth is not created by speculation or by printing more money. It is created when people produce goods, deliver services, innovate, and improve efficiency. The last era rewarded the appearance of growth rather than its reality. Companies inflated valuations without generating profit. Governments stimulated consumption without addressing productivity. And individuals consumed more than they produced. This kind of prosperity is hollow because it depends on continuous expansion of credit. Real prosperity, by contrast, compounds quietly through work, innovation, and investment in long-term value. It may not look as dramatic as speculative booms, but it endures. It creates foundations that can withstand shocks because they are built on output rather than illusion. Sustainable prosperity also demands discipline in distribution. Inequality widened during the easy money era because capital appreciation favored the few while wages stagnated for the many. When prosperity is concentrated rather than shared, it becomes unstable. Balance requires that growth be inclusive, that opportunity be accessible, and that systems reward contribution rather than speculation. The health of any economy depends not just on the size of its wealth, but on the fairness of its foundations. A prosperous society is one where productivity is encouraged, innovation is rewarded, and debt is used as a tool, not as a dependency. As the global economy transitions away from artificial growth, humility, balance, and output will determine who thrives. Those who accept that cycles cannot be cheated will build stronger systems. Those who focus on producing value rather than inflating it will endure. Sustainable prosperity is slower, steadier, and less exciting than the easy money era, but it is also more meaningful. It reflects a world where wealth aligns with work, where capital supports creation, and where success is measured not by how much one can borrow, but by how much one can build. The new financial era rewards adaptability, integrity, and long-term thinking. The world that once favored speed, leverage, and short-term gains is giving way to one that values resilience and foresight. The end of easy money has not just changed market conditions, it has changed the rules of survival. Those who can adjust their strategies, act with honesty in uncertain times, and maintain a perspective beyond the next quarter will define the next generation of winners. Adaptability has always been the cornerstone of progress, and in an environment of rising costs, shifting capital flows, and volatile sentiment, it becomes the single most important trait. The ability to evolve, to recognize what no longer works, and to build something stronger in its place, is what separates those who merely endure downturns from those who emerge stronger. The adaptable mind sees opportunity in change rather than threat. When liquidity dries up and old systems falter, adaptability turns challenge into advantage. Investors who can shift from speculation to productivity, businesses that can pivot from expansion to efficiency, and individuals who can reskill and rethink their financial habits are the ones who thrive. The easy money era rewarded rigidity, the belief that the same playbook would work forever because the system was engineered to prevent pain. Now, that illusion is gone. The rules have changed, and the landscape is unforgiving to those who refuse to evolve. Adaptability requires humility, curiosity, and courage. The humility to admit when old models fail, the curiosity to seek new answers, and the courage to act before consensus catches up. Integrity is the second defining force of this new era because trust has become the scarcest form of capital. Years of excessive risk-taking, manipulation, and short-term greed eroded the credibility of institutions, markets, and even currencies. As volatility rises and systems are tested, people seek stability not in policies or promises, but in character. Integrity becomes a competitive advantage because it creates confidence. The confidence that a business will honor its commitments, that a leader will act transparently, that a system will uphold fairness even in adversity. In uncertain times, integrity anchors behavior. It prevents panic, curbs excess, and builds the foundation upon which long-term cooperation and prosperity depend. In a world that is repricing risk, it is also repricing trust, and integrity is its true collateral. Long-term thinking completes this triad. The last financial era conditioned people to think in moments, quarterly earnings, daily market swings, and the instant gratification of credit-fueled gains. But sustainable success has always belonged to those who see beyond the immediate cycle. Long-term thinkers recognize patterns others miss because they are not blinded by noise. They understand that real wealth compounds slowly through patience and consistent effort, not through shortcuts or speculation. In the new financial reality, short-term thinking is punished by volatility, while long-term thinking is rewarded by stability and compounded growth. The investors, policymakers, and entrepreneurs who will thrive in the years ahead are those who can look past temporary discomfort and focus on enduring value. Together, adaptability, integrity, and long-term thinking form the blueprint for resilience in a changing world. Adaptability ensures survival through flexibility. Integrity ensures trust through truth. Long-term thinking ensures progress through perspective. Each supports the other. Adaptability without integrity leads to opportunism. Integrity without adaptability leads to rigidity. Long-term thinking without either leads to passivity. But when all three align, they produce leadership that endures through cycles, systems that strengthen through stress, and wealth that grows with purpose. This alignment is what the next era demands. The transition away from easy money is not just financial, it is cultural. It demands that individuals, institutions, and nations redefine what success means. The age of fast wealth, built on speculation and leverage, is giving way to an age of earned stability built on substance and foresight. Those who can adapt to this reality with integrity and patience will not only survive, they will lead. The global economy is entering a phase where wisdom replaces greed, where patience replaces panic, and where value replaces illusion. This is not a time to chase what was lost, but to build what will last.